Governments often claim that they are working for your financial freedom. They speak of stability, growth, and opportunity. But if you look closely at history, you will see a darker reality. Governments have long used hidden financial tricks to keep ordinary people struggling while consolidating wealth and power at the top. The shocking part is that these strategies are not new. They have been recycled for centuries, repackaged, renamed, yet always serving the same purpose: to transfer wealth upward and keep the majority dependent. Let us start with one of the oldest and simplest tricks: inflation. When a government spends more than it collects in taxes, it has two options. It can openly tax its citizens, which is politically risky, or it can quietly debase the currency, reducing the value of every coin and note in circulation. Ancient Rome mastered this approach. In the 3rd century after Christ, emperors facing enormous military expenses began reducing the silver content of the denarius. A coin that was once nearly pure silver became mostly copper, with only a thin silver wash. The empire acted as if nothing had changed, but everyone holding those coins suffered. Inflation soared, savings vanished, and wages could not keep pace. This silent tax on the population is a trick still in use today, now through central banks rather than imperial mints. The Middle Ages brought another version: forced loans. Monarchs in England, France, and Spain routinely compelled wealthy merchants and guilds to lend money to the crown. Refusal meant fines, confiscation, or worse. Repayment was often delayed, devalued, or never made. The crown maintained its wars and palaces, while merchants had no choice but to surrender capital. Coercion was disguised as duty, and it worked for centuries. By the 17th century, the financial system itself became a tool. The creation of the Bank of England in 1694 was not charitable. The government needed funds to fight France. Wealthy investors bought government bonds, guaranteed interest, funded by taxes. Ordinary citizens paid through duties on goods such as salt, beer, and cloth. The wealthy earned secure returns while the population carried the burden. This pattern persists today. The safest investments are loans to governments, ultimately paid by the labor of the masses. Over time, governments developed more complex ways to manipulate money and wealth. Let us examine deficit spending. Governments borrow massive sums, issuing bonds bought by investors, banks, and foreign powers. Politicians present it as a tool to fund infrastructure, create jobs, or support social programs. Yet much of the money flows to defense contractors, corporate subsidies, and financial institutions. Repayment falls on ordinary citizens through inflation, taxes, or reduced public services. Debt appears to serve the people, but it often enriches the elite. Bailouts during financial crises demonstrate the same principle. During the 2008 global financial crisis, banks made reckless bets, bundled toxic mortgages, and threatened the entire economy. Ordinary taxpayers funded the recovery, while the banks emerged larger and more powerful. Privatize the gains, socialize the losses. This pattern has repeated countless times across history. Even pensions operate as a sleight of hand. Citizens pay into government-managed retirement systems, trusting the funds will be there when they retire. Governments often spend that money immediately, leaving IOUs. Future taxpayers are expected to cover the cost. It functions as a generational Ponzi scheme, until demographics shift, populations age, and the system becomes unsustainable. Reform then comes in the form of reduced benefits, higher retirement ages, or inflation-eroding payouts. At every stage, perception is crucial. Inflation is framed as growth. Forced loans are framed as duty. National debt is presented as investment. Bailouts are portrayed as stability. Pension cuts are called reform. Language disguises the transfer of wealth from the many to the few. Most people do not recognize this because they do not study economic history or understand financial systems. Ignorance is the most powerful trick of all. To make this clearer, let us look at historical examples beyond Rome. In Weimar Germany, After World War I, the government printed marks to cover reparations. By 1923, hyperinflation reached astronomical levels. A loaf of bread cost billions of marks. People carried wages in wheelbarrows. Meanwhile, those with real assets, such as land, foreign currency, or businesses, were shielded. History repeated the Roman pattern. Currency debased, the masses suffered, the wealthy protected themselves. Zimbabwe, in the early 2000s, followed a similar path, facing land seizures, declining production, and rising debts. The government printed money excessively. By 2008, annual inflation reached nearly 90 sextillion%. Prices doubled every day. Eventually, citizens abandoned the currency entirely, switching to United States dollars or South African rand. Once again, a government thought it could cheat reality. And once again, ordinary people paid the price. In modern economies, these patterns persist. Consider quantitative easing after 2008. Central banks created trillions of dollars, buying government bonds and mortgage-backed securities. Asset prices soared. Stocks, real estate, bonds. But the benefits mostly accrued to the wealthy. The average household saw minimal gains, while costs of living and inequality rose. The pattern is clear. The system protects those at the top, while eroding wealth for the majority. Stealth taxation is another modern tool. Governments raise revenue indirectly through sales taxes, fuel duties, and inflation. When prices rise faster than wages, the real burden falls on ordinary people. Inflation reduces the value of government debt but also erodes purchasing power, silently transferring wealth. Regulation, too, can be manipulated. Ostensibly created to protect the public, powerful industries influence the rules in their favor. Railroads, oil companies, finance, and technology have historically shaped regulations to maintain profits. The public sees protection. Insiders see opportunity. War finance repeats the same trick. In World War I and World War II, governments issued bonds to citizens, framed as patriotic duty. Wealthy investors gained risk-free returns, while ordinary taxpayers carried the financial burden. Modern wars, such as conflicts in Iraq and Afghanistan, follow the same pattern. Trillions are spent. Contractors and bondholders benefit, while ordinary citizens indirectly foot the bill. Complexity amplifies these effects. Tax codes, financial instruments, and budgets are often opaque, preventing citizens from tracking money flows. In ancient Rome, debased coins were visible signs. Today, complexity masks transfers of wealth, allowing manipulation to go unnoticed. The lessons are timeless. When Rome debased coins, citizens suffered. When monarchs forced loans, merchants lost fortunes. When modern governments inflate and borrow, households bear the burden. Different eras, same mechanisms. Most people remain unaware. They accept inflation as natural, taxes as inevitable, and bailouts as acts of mercy. They trust government messaging over economic history. But knowledge is resistance. Understanding these mechanisms makes manipulation harder. Key takeaways. Always look beyond headlines. Ask who profits from stimulus, inflation, and regulations. Build wealth in real assets that hold value even when currency does not. Never assume the system works for you simply because it claims to. Systems protect themselves first. History does not repeat exactly, but ignoring it can destroy you. The financial tricks that kept Roman citizens impoverished are still active today, only dressed in modern clothing. Recognize them in time, or pay the price. If this video offered you a new perspective, subscribe. History has the answers, and we will show you where to find them.